Good morning, everybody. It's Darius Dell here to welcome you to our inaugural edition of Macro Bundle Q&A. It's your host, Darius Dell, founder and CEO of 42 Macro. I am joined by the lovely, the brilliant Nadine Terman of Solstein Capital. How you doing this morning, Nadine? Oh, wonderful. Always good to be sitting in the chair, to be bolted to the chair. It's a good day. It's
I'm happy.
Yeah, no, totally. It's been a series of good days actually, and something I wrote about in my note this morning, which I got your feedback on. Uh, Reflation is back. It's something we've been talking about, saying, "Hey, look, we think the next dominant market regime will be reflation. There'll be a process to get there. This is us writing this in mid-September. There'll be a process to get there, but ultimately, I think we've traversed that process. Going to the slides, we highlighted this in the morning note, but now reflation just poked its head out above the all the rest of the lines on this chart here in terms of our share confirming market. So now it is the market regime that is being most confirmed by asset markets, and ultimately we think this nascent reflation trade, which I would argue was being signaled by asset markets going back to our dispersion analysis as early as mid-September. We do believe this thing has legs at least into and through the end of the year. Your thoughts on that, Nadine?
You've been saying that for weeks that was the possibility, and here today on our day we get that to happen. So I guess auspicious. But I'd love to hear a little bit. It's also on a day when there's a lot of implied volatility discounts, right?
Mhm.
So maybe not in the things that you're talking about, but overall the SPY, the Qs. So someone watching today who's waking up to your R of reflation, but also a lot of overbought signals. You mentioned it a little bit in your note this morning, but I'd love to hear your thoughts. And so what does somebody do? Are they need to put protection on and then wait to buy the cyclicals? Is it okay to buy the cyclicals? What should they do?
Yeah, absolutely. So today, to be clear, today is not the day to chase inflation. As you can see here with our Brams and probable range analysis, and you have your own fractal range system that you work on. That's much more powerful than ours. But even ours is suggesting that the S&P could take a dip here. At the bare minimum, it should consolidate a sideways correction. Is that the best possible outcome from such an overbought state? You got 4% downside versus 0.1% upside. And going back to that comment you made on implied vol
Yeah.
discounts. I mean, you got the SPY down here, you got the Qs down here. SPY's down 13, or implied vol discount of 13%. Qs 9% U.S. equities broadly have a implied vol discount, a median implied vol discount of -2% for the 26 U.S. equity exposures represented in that sample. So again, not the data chase. The data chase was clearly a couple weeks ago on the first, in terms of the oversold lows that we saw there. The reality is we do believe this trade has legs. So to the extent you have not participated in grid zero or just in inflation type asset exposures in general, definitely get your buying list ready over the next couple of weeks. So are you seeing similar things on your side of the seat, Nadine?
Yeah, we have same kind of signals, but I'd love to if you can go to your page 24. I think that you mentioned grid zero, and I think that a lot of people listening probably understand what you're talking about. But I think it probably is helpful to walk through. I found that really interesting, and I'm getting that kind of questions from my clients. Is like, what's been going on, and I think it's a lot harder to navigate the grid zero versus when you're in a deep D or a very strong G for growth, because it's been popping around. You had stagflation a little bit, you have now reflation, and maybe talk a little bit about when someone sees these and you've been saying, hey, we're going to get an R. What made you think that? Like, what got you to say, okay, we're going to be heading towards reflation, so people can start to think about whether mimicking your process or understanding like how you foresee that. Because otherwise, if I go to your slide 5, sorry to put a bunch of slides together,
No, no
but I
worries.
always find this really interesting to look at. If you go to your slide 5, one of the things that someone, if they're just looking at this, just sees a sea of red and blue, right? If you're looking
Mhm.
out from October on, yeah, there's some light color R's there, but you have a lot of reds and blues, but you're talking about reflation now, maybe reflation for a few months. Talk a little bit, I think it's helpful, of like what made you foresee that, and what are you looking to see, like how sticky those R's are?
Yeah, no, that's a fantastic question. And so, going back to, let's start with the premise of the question, which is, this is easy to risk manage when it's, deep something or very obvious something in conditional probability terms. And what those conditional probabilities reflect is really just the distance from the origin on the grid chart. So when you're close to here, all the conditional probabilities will be reasonably flat. That distribution of outcomes will be reasonably flat. The further you get away from here, the more likely it is the regimes that are represented will become a pull away from the pack with respect to their conditional probability. So, as you mentioned, this setup is very different than the setups we just emerged from with respect to both the bottom up macro regime and the top down market regime. And so, looking forward into this sequence of eyes, we've been talking about this in our notes, really going back to August. When we first noticed the impact of Delta in the July data, we said, hey, we think that growth data are likely to slow into and through the back end of Q3 as a function of Delta. But if the pattern holds, we're likely to see a positive resolution of that, starting in Q4. And I do believe we're still on track to get that. And so in layman's terms, what that means is that these eyes right here, again, stagflation is the highest conditional probability for those two particular months. We think those probabilities are going to head lower as the growth data starts to recover in October and November. And ultimately, we think these eyes are likely to turn into R's. And that, in my opinion, is what the markets are trying to price in, is this evolution of I's to R's.
Because it's like a head fake, you're saying, from Delta, so it was kind of temporary slow, but it's truly, if you looked out over a few months, steady state with reopening and maybe fewer Delta counts, you're saying you're getting that acceleration. So therefore, inflation's high, obviously, in both R and I, but it's the difference of the growth of GDP accelerating versus decelerating. You're saying this, call it head fake, switches back, and that's where you get the reacceleration.
Yeah, absolutely. And in terms of what could facilitate a bounce, I mean, we've seen a sequence of rancid data all throughout the sort of the third quarter, and I believe look at Atlanta Fed's GDP nowcast, it's somewhere down 1%. So and part contributing to that, just around 1% is this downtick we saw in industrial production on Monday. This thing is contracting at a 14% annualized pace on a month-over-month basis in September. I mean, that rhymes with what we're seeing out of auto sales and other beleaguered sectors of the economy from the perspective of supply chain imbalances. So it won't take much to get data to bounce from contracting 14 to 57%, which takes you back to this chart here. It's like all it takes a little bit. It's to poke its head above that horizontal line, and ultimately, I think that's where the sector and style factor leadership has really been coming from. Again, I mentioned this process started back in mid-September. We started calling it out because again, I think we were among the first people to call out going back to early June, saying, hey, look, sector and style factor leadership's changing. It's now starting to favor defensives, growth, those types of low beta in lieu of cyclicals, which obviously had won the day from November all the way through that point. Well, all that stuff pretty much came to a head going back to that time period. And really, I think the final straw, if you will, in that process was the breaking out of the high beta in October.
And so, Darius, when if you can go back to the GRID with the grid zero, you can go back to that. So if I'm, watching your forecast week to week, month to month, and I'm seeing now, call it the first quarter plus of, into 2022, you're heading, I don't know if it's Goldilocks or it's deflation, right? You're still in the near grid zero, but you're heading out left to inflation going down in either case, so a deflationary environment, potentially this Goldilocks. What are the types of data that you're going to be looking for to have a sense that when you're still like near that axis, near the grid zero, to say where we're headed?
Yeah, I mean, it's the process is not going to change. We're the nowcast model is locked and loaded and ready to call out the things that are going to slow. Clearly, consumer demand for goods is going to slow. It's really just in terms of how fast the economy decelerates, throughout next year. It's just how long is that air pocket, or how botched is that handoff, if you will, between consumption for goods and services demand. We'd all be pretending we had a real good crystal ball in that process, but I think we all can kind of agree that the directional trend is lower after whatever bounce we get post Delta. And so I think that's sort of understanding that dynamic, that this sort of bounce here is not going to be the sustained recovery, the reopening. It's not like what we saw in the first half of this year, where you had the confluence of vaccinations and reopening with record fiscal stimulus, Obviously, consumer and business confidence was much higher. You had easy comps, obviously. You had a lot of things perpetuating.
Here, Darius.
Yeah. No. But again, sorry. The point
I'm
is
kidding.
not,
I'm kidding.
Yeah, the point is not to make you depressed, because I'll wrap up with this and turn into some questions. Is the chart that you should be most concerned about is this one. I've been talking about this for months now, which is, okay, if you're bullish in the back end of the year, you're bullish because you know that this blue line is not going down anytime soon. And we've known that for a while. Obviously, tapering, sort of won the day in terms of perpetuating the market regime phase transition to stagflation throughout the summer and into the fall. But the reality is we think reflation's on its way back because the market has to continue to price in, an albeit logarithmic ascent of the blue line as opposed to the former exponential ascent. The reality is, there's plenty of liquidity on the sideline in terms of overnight repo that could get this sort of, when the Treasury does come back to the market in size, in terms of getting on the other side of Biden's fiscal agenda, the infrastructure bill, and ultimately the debt ceiling, the Treasury is going to come back to the market. And generally speaking, that drains liquidity from the asset market right now.
Right.
There's so much cash on the sideline, particularly in overnight repo, that could actually absorb a lot of that Treasury supply to keep this line, gradually extending itself higher into the early part of next year. Eventually, the process of tapering and the process of draining that overnight repo liquidity will eventually cause the blue line to go down, and that's where we're going to start to really have some problems in asset markets. But between now and then, and I'll leave it at this, I tweeted this morning. How many times have we seen a rip your face off Q4 rally that extended itself into next?
Right.
We saw it in 2009 heading into 2010. We saw it in 2011 heading into 2012. We saw it in 2017 heading into 2018, and we saw it in 2019 heading into 2020. I don't know, past is not prologue in financial markets, but I certainly believe the liquidity dynamics and the growth dynamics, both in the U.S. and abroad, are set up to perpetuate a similar outcome.
So one of the questions, I'm going to kind of intermix my questions with some questions here from the viewers. If you can go back to 19, your playbook, right? So I can't see who wrote it, but do you think the fattening in the belly of the yield curve portends further leadership from tech rather than cyclicals? So maybe you can combine some of your thoughts on interest rates and the slope versus, some of the things that we've seen is when the slope has gotten steeper, tech has gone down, right? But we know from past, tech has been, or mega cap tech has been often positive in this type of reflationary environment. So maybe you can talk a little bit about tech versus cyclicals as they have to do with interest rates.
As we expect it to continue to flatten, particularly as what's really happening in the curve, and I'll spend a quick second on this. What's really happening is the fact that you're pulling forward rate hikes you're borrowing rate hikes from 2024, and you're pulling them into 2022. The market is effectively doing the Fed's job for them with respect to controlling inflation pressures. Obviously, you have energy price appreciation has been unabated for the past couple of months. We obviously still have median CPI running quite firm. That's on slide 56 as well. That CPI print of 5.57% annualized is the highest reading we've seen since August of 1990. So clearly there's some inflation pressure in the economy that's running quite firm. And so the market is doing the Fed's job for them. So going back to the question, yes, we would expect to see tech outperform marginally as a function of that process. But again, I don't believe it's going to be a linear process. I think the question would be better placed to say, do you want to own cyclicals versus defensives? Because again, you can have technology be represented in the cyclicals basket. To me, the discussion about being in this line is really it's about three things. Are you long or short high beta? Are you long or short cyclicals? And are you sort of long or short defensives? Defensives, low beta type things of that nature. So, when you're talking about crossing over this line, it's not about, do I have to be long tech or short energy or long energy, short tech? It's about, I can be long both energy and tech, and I don't want to necessarily be in utilities, consumer staples, things of that nature.
Right. So another question, just to get this off. So someone's asking me, like, how do I use what you do in our own practice? So we have three parts of our investment framework. The first has to do with top-down macro, and that's where we incorporate a lot of Darius's 42 macros data. The middle part is our quality value framework. So how do you select the security? And it's our definition of quality. It's based on, 25 plus years of working in public and private markets and actually being an activist. So understanding balance sheets and management teams, incentives and the like. And then the last part is more tactical. So a lot of things that Darius is talking about in addition to trading ranges. So, one way I would answer the question that you just answered, Darius, has a little bit to do with, well, if cyclicals and tech can do well, I'm going to be looking at that last part, the tactical signals, to let me know which has greater asymmetry or what's trading along my expectations. Because as we all know, maybe you think tech should do well, but the signals might be saying, hey, listen, it's not trading, it's trading more as a bond versus in a reflationary type security. So that's what we look at. So those three things, there's top down, call it bottom up, and then tactical, to be able to, hopefully you get that aligned. But for us, the portfolio construction of that, what you really want to do is have non-consensus positions. So that tactical piece, you want to be having, implied volatility discounts. You want to be having positions on the CFTC futures and options positioning where people might be short if you want to go long. Those sorts of things to decide where should you weight more heavily. Because just because the back test says to do something doesn't mean it's trading like that now, or will it be? So you have to put both of those things together. Sorry, go ahead.
This is something I've learned from you over the years, which is, not putting all your eggs in one basket, to allocate according to themes, right? Yeah. Like, so if you're in November of 2020, this whole pie is like lime green, right? This is like, we're going full bore inflation, Bitcoin's going 100,000, see you later. If you're in February of 2020, this whole pie is dark blue. It's deflation, we're hunkering down, it's get the sandbags out and the canned goods. Right now, as we've been talking about this, the distribution of probable outcomes economically is actually quite flat. And so as a function of that, we have a quite flat asset allocation. And this is something, again, I've learned from you. By the way, you guys we're all very privileged that Nadine can take time out of her busy schedule to hang out with us every week, at least for the first little while. So Nadine will be very modest, but she's truly one of the smartest people in finance. I think she graduated summa cum laude at Stanford in like a year and a half.
No. The stories are starting. But anyway, someone's actually got an interesting question here on the VAMS lookup. So maybe you can go to your VAMS. They're asking about the periods of momentum, and the volatility regime dynamic, or is it more static? So, is it, for example, 3 months over 30 vol for SPY, or how do you think about creating this, using it?
No, it's a measure of momentum across various durations. So it's a relationship between short-term momentum, which is usually 15 to 30 days, depending on the asset, and medium-term momentum, which is 100 to 150 days, depending on the asset, between both price and volatility. As you know, most risk assets volatility is inversely correlated to the price. And so for something, if we're looking at the S&P 500, which actually broke back to bullish this morning, for that to be bullish, you're saying the short-term price momentum, STPM, is greater than your medium-term price momentum, versus your short-term vol momentum is lower than your medium-term vol momentum. It's actually not exactly complicated. I'm sitting here. I'm a pretty smart guy, but I am not Jim Simons. This is we got to keep it simple, stupid. But the reality is we're standing on the shoulders of giants, and when we create models like this, because you read Misbehavior Markets once, you read it twice, you read it 3 times. I've read it 4 times. The one thing that sticks out to me from reading that book is volatility is a leading indicator for price changes, for trend changes in price, for the behavior of price change or behavior of price sequencing. And so if you can use those vol signals to help you get some color, and not necessarily color at the asset class level or at the exposure level, but more importantly, those neutralities, that gray bar doesn't mean much in isolation, but it has an enormous impact on this table. Because what it does is it takes something out of being bearish or out of being bullish, and you start to dissipate the overall regime scores therein, and allow for a regime change sooner than you would otherwise notice, just sort of isolating one particular exposure.
Well, some interesting questions on options and some tickers that rip, but I want to just go to clean out one of the questions on grid zero. So you can go back to grid zero, and when you're going to a definite R, right? So I know it's just one day you had a higher probability, but you're expecting, call it many days of higher, or at least as high probability, maybe higher, where it's got the dominant force there. How should the portfolio construction change? It'll be interesting to hear what you have to say, and I'll answer it too after you, of like, what would we do versus what would you do to be able to advise people?
Yeah, no, that's a great question. So, by the way, that the one out there.
That's Rich Lowry. I can see the name now.
Hey, what's up, Rich? Brother Rich, what's up, man? How you doing? So the short answer to that question: these are not definite R's. I mean, I think there's a litany of headwinds economically that may prevent that from occurring. Again, I do believe they're likely to occur, and it's not me saying that. Clearly, the probabilities are such that they could very easily occur without much cajoling by the data. In terms of the nowcast, but I do believe there's enough out there that could scare you. I mean, look at on slide 31, we sort of highlight the impact of supply chain disruptions, and they continue on unabated. You look at this chart shows the 2-year break even that's still at a cyclical high. In fact, it actually made a new high. Baltic Dry Index made a new high. Blue line here is the percentage of ISM manufacturing respondents who are saying deliveries are taking longer. That actually ticked up in September, and obviously it's very elevated relative to any historical time series. Same thing with services as well. So if these things continue to get worse, we're not going to see that bounce. And those R's, particularly from a market regime nowcasting side, because again, we just turned into R on that from that perspective, in terms of the dominant market regime. Maybe it's transitory. Now, again, I do believe it's not going to be transitory. And if it's not going to be transitory, if we're right on that, then I don't believe you need to do a whole heck of a lot from a portfolio construction perspective anyway, with the exception of maybe putting some of this cash to work. Because if you're an R, Goldilocks is going to work. Obviously, reflation is going to work. All these assets are going to work. They all go up when you're in reflation. They're talking about commodities, energy, cryptocurrencies. You're going to get some underperformance in defensives, going to get some underperformance in mega cap growth, and obviously you're likely to get some underperformance in TLT and EDV. Sure. But the reality is, if we continue to see curve flattening, i.e. if bond yields don't keep going up much further from here, and again, that's the Jackson 5 versus the Hanson Brothers thing I've been talking about the last few weeks. I don't know that how much more these things are going to go down. So in terms of reallocating the portfolio construction, I don't know that it'd be prudent to say, let's just go full bore R, because this is not November 2020. The only thing I think I'd be willing to do is, if we do get a dip over the next few weeks, to redeploy some of this cash.
I think for me, I'd be willing to take some of the things some that do well in Goldilocks, as you're saying, and the inflation bucket, but also I try to use your slide 5 along with this to say, okay, well, are there certain countries that have a higher likelihood of that R or that G, or their regions, right? So in the Eurozone. And then maybe you can pick, if you want, you can pick a ETF like EUFN, which is European financials. That's one way to do a broad brush if you don't know specific companies, or if you want to spread your bets on energy. So like we own, it's out there. So it's not like it's a secret. Shell, BP, really great. Other ones in Canada and the like. So energy companies all over Europe, North America. And so you can spread that bet a little bit, and you might be able to pick up a little bit of alpha by combining the grid here along with the playbook. So that's one way we think about it. The other way is kind of what Darius is talking about is what you don't want to do is say like everything's R and there's nothing else. So sometimes it's very obvious, for us, it was January 2020, to be able to get defensive. But then at other times when you're at that grid zero, even if you do see some R's popping up, you don't want to be 100% R, like not having shorts on, not having cash. And I know some people say, oh, cash is a dumb thing to have. It's not. There's some really interesting papers about the usefulness of cash, because you're not going to sit on cash forever. Sometimes what it does, it lets you deploy quickly. So for example, some of our institutional accounts, it takes a while for them to exchange currencies and like, so it enables us to act faster, to have certain levels of cash in accounts. So there's a whole host of things you can do. And it kind of gets to one of the other questions here from Sarah is, how do you implement options in the portfolio, specifically when things are overbought or oversold? So that assumes that you want to be using options, that question. But do you have any thoughts on how to advise Sarah and others and how to think about using options when some of these signals, whether it's implied volatility premium discount or VAMs or the like, are saying, hey, be a little bit more cautious.
I mean, so I'm sure most people on this watching this will tend to agree with this, is that short-term options are where your money goes to die. So naturally, the natural inclination is to say, okay, the market's overbought. Let me go buy a 2-week forward put or a 3-week forward put, maybe at the money and try to make some money on that, or maybe price it 1-2% lower and try to make some money on that. And more than 50% of the time, those things are going to expire worthless or go down a lot.
Yeah.
Because again, the way retail options are priced, you're just not getting good enough pricing on the theta and Vega exposure in that regard. So the best way to do this is with fresh capital. You're not chasing here. You're not selling here. And if you're trying to get out of exposures, you're obviously not selling at the lower boundary of the probable range. You want to use the ranges to guide your forward-looking asset allocation.
One thing that we can do, and what was that, with Sarah, is that if we think that something is way overbought and maybe the regime is changing, is that we will put on 1 month or 2 month forward options to protect something for the interim, because it is such a large percentage of a portfolio. But we've also found that you have to be a little bit careful. If you try to use a broad-based sector, it may not cover the security that you're looking to cover. Sometimes if you're looking to cover something, maybe the implied vol is just way too expensive for that security. So you have, it's not like there's a set it and forget it rule that you can follow on these things. I think that you have to have someone, either you or someone on your team, watching for, is there some attractive way to do something? Similarly, if you have a loss, like, can you take the loss if, let's say, the market's still, rip roaring ahead, and then roll those forward if you still think that there's some major concerns? Like maybe you're in August going into September and you need to do that. And that's one of the things we did. Or maybe you need to just like have a good old-fashioned vol, go long vol, right? So there's different ways you can think about this. But I don't think that there's always one way, because you have to say, well, what am I trying to cover? Why am I trying to cover it? For how long? How expensive is this? Because sometimes the insurance is just, as you're kind of pointing out, Darius, it's way more expensive than it's worth. And you should have just had some cash on hand to figure out what to do with it. So Darius? Are you there, Darius?
You're saying how expensive is it?
Tickers that just rip and tank. So whether it's, your Bitcoin, uranium, and thanks to everybody here. So thanks, Larry. But for me, like, how do you handle it? You got to like trim, you got to add. So, it was the right call. And you sometimes have to figure out why something's happening, which I know that not everybody has the data to do. And so, and a good example, is like you had crypto way up, and then, crypto fell, but Ethereum was doing better than Bitcoin. So it's a bit of a nuance, right? Well, you could see that some people were shorting Bitcoin. Maybe they were protecting against something. And they were going, maybe also just because Ethereum was trading better and they were longer Ethereum. So when you went from this, scare about stagflation to reflation, yes, Ethereum went up, but you saw a much larger jump in Bitcoin because people also had to cover, right?
Yeah.
And so, like, how do you handle it? So when it's down, obviously you want to be adding that to position. It's rip roaring. You're getting some really good, obviously political benefits in the last couple of weeks, and more institutional type news coming out here. So you take that into consideration. But then if you're at the top end of a trading range, it can be hard because it's, it's hard to get rid of the one that you love. But just like anything that you love, sometimes you gotta trim it back a little bit. And so, that's what I would say is like, how do you have to be able to trade these things. I tend to go a little bit more heavy handed. I don't always go in and out of a position, but I'm much more willing to, man, if I luckily got overpaid on something, I don't mind wiping it off. I don't look back. But you get more mad when like you had a run up and you knew maybe you were going from reflation to deflation and you should have either protected it or trimmed and sold it. So I think just being really data dependent is how I would answer that. But I'd love to hear you, Darius. Like, how do you answer Larry's question about dealing with these tickers that, like rip to the upside and tank as well?
Yeah, I mean, it's just part of the process, right? I mean, you have to understand that part of having a balanced portfolio construction is to allow yourself some of that flexibility. I mean, when I talked about this going back to August and we put on the Bitcoin exposure, which is saying, hey, look, we now have two extremely high vol exposures in the portfolio construction between Bitcoin and Ethereum. You don't need to be fully invested in the context of that because these are effectively 8% positions when you factor in the volatility. So this cash position looks high in the context of having a transitioning to reflation, but you also have to realize you're definitely taking a little bit more risk than you think you would be in terms of being 80% invested. So it's all part of the process. It's all what we're trying to do is create a thoughtful, balanced portfolio that is designed to survive the next few months of market regime. Right. And obviously everything we think about the market regime and how that's going to evolve is based on our forward outlook for the economy. And so, as we mentioned earlier, because I saw another question, Mike's asking the question that was asked earlier, is that if we transition to R, is that a catalyst to change the portfolio? And again, Mike, we got to that, so we'll catch that on the replay. But the short answer was, no, this portfolio construction is set up to design to get you into and through those couple of R's that we see coming down the pike and into the early part of next year.
And Steve has a question here, staying on that narrative about growth is going to be slowing, and there's inflation, going to be sticky. Why would stocks go higher? That's the question from Steve. I'm going to, after you answer, give a little bit of nuance on this, but maybe you can let Steve know from the data that you look at, like how does that happen?
Yeah, so the quick answer is that the growth is already slowing. I mean, if you look at our nowcast for the U.S. economy, it's pretty clear that growth peaked at sometime in the middle part of the second quarter and really started to accelerate to the downside. Starting in July with respect to the Delta variant. We do believe, if you look at some of the rancidness, if you will, some of the data, 56% annualized contraction in August sales in September, 14% annualized contraction in broad industrial production growth here in the U.S. in September, it definitely it sets the economy up in terms of having a very easy handoff to accelerate from. Now, again, I do believe the unwind of Delta is a catalyst in and of itself, in so much that vaccinating school-age children might increase supply of female labor force, increase the female labor force participation rate in a way that is additive to economic activity in Q4. So, it's very likely we see a bounce. We may not see a bounce because, again, as I mentioned, so all these supply chain disruptions continue to actually get worse. So we're kind of we have all these different factors shocking the economy, and this takes me back to where we started the conversation, which is the range of probable outcomes, you can't even see it anymore, but I'll tweet it out. The range of
Right.
probable outcomes economically is very, very flat. The distribution is very flat here in Q4. We think that the net liquidity dynamics that have really supported the market to this point are likely to continue. So all things being equal, we're just likely to be positively exposed to risk.
So I'm going to give you a little nuance, Steve. So if you can go back to that page 24, the US grid,
Yep.
there's a really interesting, it's actually a series of studies that Goldman did. And then I actually did it with my own data just to make sure I believed it. That says, imagine two of these. And it depends on whether PMIs are above 50 or below 50. And so one of the things that Goldman found was that when PMIs, or actually 53 is the real threshold, but 50 for right now, that if it's above there, there's just less risk. People are happy when there's a certain level of activity such that equity markets can remain buoyant. But the risk really comes in two things. One, when growth is decelerating, you don't get the same level of returns in risk assets. When you start heading lower of, decelerating growth below 53, I think as the market smells out that it's going to be probably below 50 at some point. But there's this major threshold at that point when then growth starts to decelerate below 50. That's obviously your deflation environment. But then if growth is coming, even if the PMIs are, below 50, if growth does start to reaccelerate, you actually get some of the best returns. So you're back into, call it a Goldilocks scenario with PMIs below 50. But there's these thresholds around 53 and 50 for PMIs. That's kind of like having two layers of this grid chart. And I think that explains a little bit of what you're asking, which is there's a certain level of growth which is acceptable and people will still, fund and make a liquid market. But then after a certain point, they get way too nervous and they start pulling that liquidity. They're not happy enough with that growth level and they can see it declining. They don't know where the bottom is. So they start to pull more. So it kind of combines this with how investors actually act in the markets. But I found those studies to be really fascinating, and they actually layered out a whole plan of how you would invest in each of those scenarios. So I can't give that out, but if anybody has Goldman access, it came over the several years, and I just thought it was a really intriguing economic study.
Right. So we've obviously kind of for a lot of those dynamics in terms of our grid asset market back test, which, as you know, sequence literally everything taken under the sun. And what we found is that we call this our zero sigma, which means growth is moving modestly in either direction. And so when you look at just overall the back test, when you're talking about being in deflation or inflation, they're negative. If you look at the S&P 500 returns for using that as a proxy for risk assets, the annualized expected return is actually down. But when you transition to a zero sigma inflation or a zero sigma growth, you're talking about positive expected values, right? Yeah. Like those things have actually historically been. Oh, sorry, it's actually quite high. Those things have actually been really positive for asset markets. And so what that means is that we've been conditioned as investors of real interest rates, takes the kind of keeps the Fed in play in terms of the liquidity and the punch bowl that we've been really really addicted to since 2009. I mean, really ever since the advent of the QE era. This is really the only thing that's mattered, and really we're just using the grid process to front run changes in the blue line. Sometimes the blue line's got to go up because we slow, and sometimes the blue line's got to flatten out because we accelerate, and vice versa. And that's all we've really been doing, right? And so that's this whole process is understanding that, hey, even if growth does continue lower throughout Q4, as long as it's not sharply decelerating, this thing is still probably good enough to carry us higher. The issue, going back to those grid asset market back tests, is when you start to layer on the sharp decelerations, like a -2 sigma delta. So what we're saying, the delta on growth is actually an absolute value terms is 2 sigma or above, and that's when you start to really bring on the negativity from the perspective of asset markets. That's when vol gets really high. Things of that nature, percent positive ratios get really low. So that's something we're factoring in as well. And so we obviously have to have forward-looking views on, okay, what's the pace of deceleration? One, what's the direction
Right.
of travel as an investor at all times for both growth, inflation, and ultimately monetary and fiscal policy. Number one, what's the direction of travel? Right now, the direction of travel is slightly up for a little couple of months and then back down.
Yeah.
What's the pace? Slightly up, potentially meaningful, but certainly not lasting. The pace won't really start to materially decelerate. Now I got a comment. Here we go. Materially decelerate into the middle of the first quarter, if not the second early start part of the second quarter. So pace is number two, and then lastly, destination. Where are we headed? Where's the bottom of the sine curve?
Right.
This is still well above potential growth. If you're talking about 4%, that's Bloomberg consensus estimates. I happen to think it's likely to wind up somewhere closer to 2.5% by the time we get into the back end of this year. Because throughout this entire process, don't forget markets are going to be tight pricing in tight monetary policy at
Right.
the margins. And to me, I think that confluence of not necessarily having the same impulse from a fiscal policy perspective, clearly not going to have the same impulse from a reopening perspective. We already vaccinated 75% of the people. And then lastly, sort of getting closer and closer to liftoff from that perspective. I just think, this expectation that growth is still well above trend at the end of next year is a misguided expectation. But again, that's not something we have to price in.
Right. You have to do it today. There's a couple of questions here on implied volatility. There's one from Robert, and then there's an anonymous one, but I might try to put them together. So one is about any thoughts on IVOL in the current conditions, but then also like how large of a risk do you see short term to assets, given the fact that we're seeing these discounts pretty much across the board. They're asking 3 to 5% or more. Or what are we talking about here in terms of risk?
What are you actually? So our probable range on the S&P 500 has 10 basis points of upside and 4.1% of downside. Now again, I don't know that we're going all the way back down to the downside because I happen to believe that that a lot of bears are trapped in this sort of late September October period, and now they're looking up at a market that's gone straight the heck up, and looking up at a lot of risk assets that have gone straight the heck up, and they're starting to underperform. And this is how you get those Q4 performance chases, and people are looking up at markets and saying, "Oh man, I'm not exposed enough." Or man, I short sold the lows like a bozo. Or sorry, I don't want to disrespect. You're not a bozo if you short sell the lows. I apologize.
I'm from Chicago.
We're not here for name
Bozo the Clown was actually like on a local TV station in Chicago. Like I remember watching Bozo, so I don't even know if people know do people know who Bozo is? But
No. We had Homie the Clown back in my day. That's in Lemon Color.
Okay.
But anyway, so that's neither here nor there. We're not here to name call and make fun. We're it's all positivity.
Yeah, but I have, for example, my SPY range is down 4 with another 1% upside. So you get,
1% upside.
Yeah, so that's kind of what I have just for today. Like right now, I just put it in here, so that's calculating real time. But I see, a pretty high level of short interest on the SPY, so that particular security. But it is trading at an implied volatility discount, and so you have to be looking at those things that it could go either way. There's a discount here, but there's also a lot of short interest. So you can't necessarily say that that's like a full on. I would short the SPY. But what you're seeing here is that the asymmetry obviously is more to the downside. But as you're talking about, there's a lot of people who aren't full in on this reflationary bet, so they might be adding more fuel to this market melt up.
Indeed, they may be. All right, we'll wrap it up there. Thank you guys for joining us. Apologize for the brief technical delays. No worries. Who knows what happened there, but we'll try to get that cleaned up. We'll do the reconnaissance and get that cleaned up for next time. Thank you guys again and gals for joining us on our first edition of Macro Bundle Q&A. We're going to be doing this every Wednesday starting at 11 a.m. Eastern going forward. Thank you. Have a blessed day. Best of luck out there. Cheers. Thank you, Nadine.